Hey guys, and welcome to today's session. This session is all about understanding your Darwin in more depth. So this is kind of a follow-on from the session that we run earlier on in the week where we talk about Darwinex Zero, who we are, the basics of risk, all those kind of things. Now, I kind of like these two sessions to be run separately so that people who come to the Tuesday session can then attend this Thursday session and kind of get a bit more of an insight on the more complex things when it comes to trading with Darwinex Zero and having what we call a Darwin. So that's the stuff that we're going to be taking a look at today. If you've not been to one of these sessions before, it's a great place to come and, like I say, just really jump into the nitty-gritty, what your Darwin is, how it acts, what VAR means, and all that sort of good stuff. These sessions are recorded as well, so if you can't stick around for the whole session, or if you miss some of the session, feel free to watch it on YouTube or X. There will always be a recording of all these sessions, and if you're not in the Darwinex Zero Discord, make sure you join, because why wouldn't you? My name is Kieran, and I'm head of UK growth and business development for Darwinex and Darwinex Zero. And just to touch on just to touch on Darwinex, if nobody, I'm struggling to get my words out. It's almost Easter, so things are slowing down. If one of you hasn't heard, or if any of you haven't heard of Darwinex in the past, Darwinex is our parent company, sister company, whatever you want to call it, which is a regulated asset manager, broker, and hedge fund. We hold three separate regulations in three different jurisdictions. So we're regulated by the FCA in the UK, by the CNMV in Spain, and also by the FSA in the Seychelles. We've currently got over 100 million US dollars invested in the platform by third-party capital, outside of anything that's owned by Darwinex. And we also have roughly 10,000 active strategies on the platform. Now, we call them strategies because we do have less traders. Some traders have multiple strategies, right? So we do have traders trading 5 or 6 different accounts with us, which is completely fine to do so. So let's jump straight into the meat and bones of today's session. So what is the point of a Darwin? Again, if this is your first time hearing about Darwinex Zero or hearing the term Darwin, to keep it super simple, your Darwin is basically an investable index version of your trading strategy. So it's managed like an index with an independent risk manager hosted by Darwinex Zero, which is what we're going to go through in today's session and how it relates to your trading. Now, the point of having a Darwin is that your Darwin is a risk-adjusted version of your strategy. So you understand on a much deeper level the exposure and the risk that you operate as or with as a trader. You operate under Darwinex's regulatory compliance. So your Darwin is regulated and it's held under Darwinex's asset management license, which basically means that you don't need to be independently what would you call it, regulated, as in you don't have to have a certificate of regulation, you don't have to go out and pay the FCA or whoever your governing body is to become a regulated asset manager, because it all goes through Darwinex. Hence why we risk adjust your strategy so that we know that if we're bringing on investors, we know that their downside is capped. And thirdly, you also get a proven track record from an FCA regulated broker. So obviously Darwinex is FCA regulated, which means that you can take the track record from Darwinex to any professional firm and that track record will hold up. Darwinex generally has a pretty good name in the industry. Again, we do hold multiple regulations, so your track record will be trusted by third parties. Now, the first thing to note is that your MetaTrader account, which is your signal account that you receive from Darwinex Zero, which is a virtual account of either 100,000 US dollars or $1 million US dollars, depending on the account type and the assets that you decide to trade, they will differ from the results of your Darwin. So, of course, because your Darwin is risk adjusted, the returns will be different and the max drawdown will be different, because your Darwin will be trading at different size and will be managing the positions in a different way, which is all down to your deleverage, which we won't go into detail in today because deleverage is quite a complex topic. However, today I have just opened the Darwinex Zero 101 forum in the Discord server, and it's got a load of videos. If you wanted to explore this sort of stuff in more detail, detail. Those videos will explain, it's like a 1-minute explainer video on each of these topics. So at least if you go through all of the videos in there, you'll understand your deleverage, your value at risk, the risk engine, all of these things and how they work together in much more detail. But this session is more of a broader coverage of sorts. So your Darwin statistics will always be different purely because it is risk adjusted by a proprietary risk engine. Now, our risk engine adjusts all traders' trade sizes to maintain a value at risk, or VAR, as we call it, or VAR, of around 6.5% per month across the board, meaning that every trader is trading at the same level of risk. So value at risk estimates how much money you could lose on an investment over a specific period of time under normal market conditions with a certain level of confidence. Now, I understand that's kind of a really, really weird way to explain something. It sounds very fluffy, but I'll give you an example so that it actually makes sense. So if a trader has a value at risk of $1,000 with a 95% confidence level over a given month, it means that there is a 95% chance that that trader won't lose more than $1,000 in any single month. That is basically explaining this. I just feel like the words don't always get the message across as well as the example. So that when we're offering your strategy out to investors, they know that there's a 95% chance that 6.5% or your specific value at risk is going to be their maximum downside for the month within, a 95% confidence level. So of course, this is investing, this is trading. We can't guarantee things. We can't say for sure or with 100% certainty that something won't happen. But what we can do is we can mitigate a lot of the instances where it may happen or where it would happen. And by us doing this, what it does is it creates a level playing field, ensuring that traders are based only on their skill and not the amount of risk that they're willing to take, or not the position sizes that they're taking. For example, two traders could take the exact same trades. If one trader took it with a 1 lot and the other trader took it with a 10 lot, and they ended up taking a 3-to-1 risk to reward on that position, the trader trading a 1 lot might take 3 grand. The trader taking a 10 lot might make 30 grand, as an an example. Now, would you say that the trader who made 30 grand is more skilled, even though they did the same trade, they managed it the same way, and they took the same risk to reward or the same percentage profit on that position? I would argue no, that trader's not more skilled. All they're doing is they're playing with larger size. Okay? And so what we do is we try and diminish that element and take that away from the competition. We don't want you to be rewarded just because you're happy trading with bigger size. We take the size, we risk adjust it so that every trader is judged based on how good is your trading over an extended period of time. So not within a week, not within a month, but within a year, within 2 years, 5 years, 10 years. Who is the better trader over time, and who provides the best risk adjusted returns? And you might be asking yourself, why 6.5%? It's a bit of a random number. Well, it's actually not random, because 6.5% value at risk is the S&P 500's risk level. We know that investors are familiar with investing into the S&P 500 and that they're proven to tolerate that level of risk even through drawdown or through, heightened volatility like what we've seen recently. So we adjust your strategy to a risk level that we know it ensures meets the investor's expectations and risk tolerance. And just see, we have a message in the Discord, so I'm just going to go over that now. It's from Billionaire81. Why do we have to pay to join Darwinex? So it looks like you've asked 3 questions. So the first question, why do we have to pay to join Darwinex? You don't have to pay to join Darwinex. We have an FCA regulated broker that you can join for free and get all the same benefits that you would get on Darwinex Zero. So you don't have to pay to join Darwinex. Of course, you would be paying in broker commissions as you do with any broker in the world. So that would essentially pay for the software. With Darwinex Zero, you wouldn't be paying broker commissions because it's all on a virtual account. We're therefore then giving you software. We would be giving you allocations. We would be hooking you up to investors. That all costs money. We have like 70 or 80 staff. they all get paid. So you have to pay for access to the service. But again, you don't physically have to pay because you can join Darwinex and, like I say, get all of the same benefits without having to pay that monthly cost. So I hope I've squashed that question. Second question, when you copy our signals, is that not an infringement on the trader's IP? No, because you sign a contract basically agreeing to become a signal provider. It's exactly the same as trading with another broker. Every single broker that you place a trade with has access to your trades and has access to your positions. We don't run a B-book at Darwinex. We don't have a B-book functionality in our broker, which means we don't trade against our traders. Any other broker who runs a B-book means they actively trade against you or take the other side of your positions. To me, that's more of an infringement on my IP than anything else because, it's a clear conflict of interest, right? They want you to lose and therefore they're trading against you. Agreeing to become a signal provider to the Darwinex platform, that's not an infringement on your IP. Your IP is protected to anybody. I don't even see traders' trades, and I'm head of the UK growth in Darwinex, right? So I can't even see your trades. I only see the risk-adjusted version. The only people that would be able to see them, I guess, is kind of the trade and operations team. We are regulated, so, there's stringent rules in place for us to adhere to when it comes to traders, when it comes to intellectual property, GDPR, all of that stuff. So there's no issue with that. And you sign an agreement to become a signal provider anyway to Darwinex and have a Darwin created. If you didn't want to do that and you didn't want to, be displayed to investors, that's absolutely fine. Like there's no beef. And then the third question, do the earnings go up or remain just the same percentage from the beginning? Or if the trader proves his worth, the earnings potential will rise? The percentage, no. Again, we are a regulated asset manager and hedge fund. So we pay hedge fund percentages, right? So a standard hedge fund will charge 20 and 2, which means they will take a 2% management fee from any of their clients, and they would take a 20% performance fee. The hedge fund generally keeps a percentage and then pays a trader percentage. Usually it's kind of 50-50. So at the end of the day, the trader would keep 10% and the hedge fund would keep 10%. It can differ between different hedge funds. We charge a 1.2% management fee that goes to Darwinex, and then we also charge a 20% performance fee. Darwinex keeps 5% and the trader keeps 15%. So we actually pay over the odds against most, or the benchmark for most hedge funds, to our traders. The only thing that can scale is the amount of AUM that you have. So you can always scale AUM and investor capital through Darwinex, which therefore would make your earnings potential rise. And so, yeah, I hope I've answered all of your questions. I've tried to answer them to the best of my ability, but let me know if you've got any follow-ups from that. We've also got a question from Yanis. I'm guessing it's Yanis. You don't call it Giannis. So, yeah, Yanis, perfect. Yanis said, hi, what happens if my VAR is less than 6.5 and I buy the 100K allocation? Will you adjust it to reach 6.5? So your value at risk on your Signal account will get risk adjusted to 6.5% on your Darwin anyway. So your Darwin will always be operating at a 6.5% value at risk. You have your Signal account, so that could be 2% value at risk, 20% value at risk, 200% value at risk. And we always risk adjust it so that at the Darwin level, it operates at 6.5% value at risk. So if you're operating underneath, like let's say you're operating at a 3.25, your Darwin is going to be taking twice the position size. So if you're taking a 10 lot on your Signal account, your Darwin would be trading 20 lots on the, within the balance multiplier of that account. Obviously, you might be trading with a 100K virtual account and 50K on your Darwin. So therefore it would be 0.5x from the balance multiplier, but your actual lot size would be doubled. With the 100K permanent allocation, then yes, that will always be on Darwin level. So you would get the increased risk on that 100K permanent allocation, or the increased value at risk, I should say. Again, I hope I've answered that to help you fully understand the VAR and the allocation. But if you've got any further questions, please just shoot them in the chat and I'll go over them momentarily. On your Darwinex Zero dashboard, on the return/risk tab, this shows your Darwin's return. So it doesn't show your Signal account return, hence why these statistics may be slightly different to what you would see in your MetaTrader account. You can view your Signal account statistics by clicking the Signal account option. However, this is private for everybody else, so nobody can view your Signal account statistics. So nobody really knows how you're performing on the back end. They only see your Darwin, because at the end of the day, the Darwin is the thing that investors buy into, and it's the thing that gets marketed to investors through the investor marketplace at Darwinex. So they don't really need to see your Signal account. Now, I believe on Darwinex, you can see the Signal, or it's optional to be able to show your Signal account statistics. Not everybody does it, and not everybody has to do it. But there is an optional parameter to enable that ability to show your Signal account statistics. Now, understanding your value at risk. So you can go on your strategy analysis tab on your Darwinex Zero dashboard. And if you scroll down to the bottom, you'll see this chart, which is Signal account risk management, or in other words, just your VAR chart or your VAR chart. Now, we've made it nice and easy. We've stuck a big fat white line and called it 6.5% so that you can see where the benchmark is. Now, this Darwin was trading above 6.5% value at risk to begin with, roughly about 13%, I would say, at the beginning of this chart. And you see at that point, we've shown that the risk engine would be scaling this trader down because they're operating above the VAR of 6.5%. At 13%, the trader would be getting scaled down by 0.5x. So every 10 lot the trader takes, the Darwin's going to be placing 5 lots. As it comes down over time, your risk multiplier is going to increase. So they work in tandem with one another. When VAR goes up, your risk multiplier comes down. When VAR goes down, your risk multiplier comes up. So it's kind of a really healthy relationship between the two. So your Darwin will always come out at the same result, no matter what your VAR is, or no matter what lot size you trade. Your Darwin will always get recalibrated and come to the same result over time. So Yanis has said, my EA trades 0.5 lot per trade, but it trades 28 Forex pairs. So sometimes it may open more than one and up to 10 trades of 0.5 lots at the same time. So if my VAR is 3.25, what will happen then? Nothing will happen. It depends how consistent your EA is with the position sizing. So what we do is we measure something called deleverage. So I'm going to grab a video for you now, because it might be, this video will answer all of the questions that you're asking now. Copy message link. So I've just posted a link to a video in the chat. After this session, I'd go and watch that. It's literally like a minute or a minute and a half long. It talks about deleverage and how we measure your exposure using deleverage. What we do is we don't measure you by a trade basis. We measure it on a position. So a position all gets measured back to Euro USD. So if you're in Euro dollar, pound dollar, USD, JPY, all of these different pairs, they all get measured against the volatility of Euro dollar. We then measure the leverage of those as a position. So you might be net long Euro, net short pound by X amount. We measure the leverage from that. That then calculates your value at risk, and then that will go up or down based on your exposure at any given time. But I wouldn't worry about your EA. I mean, 0.5 lots per trade is quite low anyway, so I wouldn't worry too much about that. As long as your VAR is stable, that's the only thing I would be concerned about. If it was up, down, up, down, up, down, I'd try and level it out slightly. But if it's, you know, pretty stable at 3.2 or 3.25, I'd literally just keep it like that. There's nothing to worry about. Now, when this trader's VAR crosses 6.5% to the downside, you can see the arrows change. And what the risk engine is going to be doing then is it's actually going to be scaling the trader's risk up at Darwin level. So as we fall down, the lower the VAR goes, the higher the risk multiplier goes, and the bigger increase in risk size on the Darwin level. This is an organic chart. It has a life. It follows everything that you do. Every decision you make and every trade that you make will update this in real time. It has a 45-day look back period. So it looks back at your 45 most recent trading days, compares it to a 6-month average, and decides whether you're being under or over leveraged. And then it will level out your VAR score. You also have a Darwin live trades option on your Darwinex Zero dashboard. This is private to you, so only you can see your own Darwin live trades. It shows any positions that you're in, and it also shows your current risk multiplier, what I was talking about. The Darwin risk multiplier, where on the screen it says 2.32x, that is what it works in tandem with your VAR. So as your VAR goes down, this Darwin risk multiplier goes up, and vice versa. You see with this trader, or this Darwin specifically, the Darwin is being scaled up by 2.32x, which means for every one lot the trader makes on their MetaTrader, their Darwin takes 2.32 lots. Okay. The current closure rate shows how much of the position you have open that the risk engine has intervened with. Again, measuring your deleverage, the risk engine can get involved if your deleverage gets out of proportion or starts to increase. The risk engine can close some of your position to bring your deleverage back under the threshold. Underneath, you can see it says New Zealand yen. So it shows you the trade that you're in, whether you're long or short, how many contracts you've got open on your MetaTrader, and comparatively how many contracts that you have open on your Darwin. So you can always see how it's being reflected in real time. To go back to the example of having two traders, one who trades a 10 lot, one who trades a 1 lot, but take the same positions. Trader A is trading with too high of a lot. Trader B is trading with too little of lots or too small position sizing. So what the risk engine will do in general is scale trader A down and scale trader B up so that they meet in the middle at the standard risk level of 6.5% value at risk. When they meet in the middle, both traders are operating with the same risk, and it really is at that point just a race of who can make a better return instead of who can risk more to make a better return. Your strategy's value at risk depends mainly on 4 factors, although number 4 is the biggest one and it's the easiest one to manipulate. But number 1 is asset volatility. So if you're trading assets that have a higher inherent volatility to them, for example, Bitcoin, gold, yen pairs, exotic pairs, instead of, FX major pairs or the Bund or something like that, that can increase your value at risk. Because obviously you're trading assets at a higher volatility or have a higher inherent volatility. Number 2, your trade frequency. The more trades that you take, the higher your value at risk will be. This isn't to say that taking more trades is necessarily a bad thing. It's just saying from a risk exposure or a leverage perspective, you are higher in risk, whether slightly or, by a big country mile. Number 3, you have trade duration. Again, the longer you're in trades, generally the higher the risk is because you have more leverage exposed to the market and more risk exposed to the market. And then number 4, which kind of trumps them all, is your position sizing. So you could trade the least volatile asset like euro dollar, trade it once a month and, sit in that trade for 30 seconds. You could do everything right from points 1 through 3 and then trade it with 400,000 lots, and you're still going to be operating at really high value at risk. So even though 1, 2, 3 kind of exist, the easiest one that you can change and manipulate is number 4, which is your position sizing. The only thing with this is any changes to your position sizing should be done gradually and over an extended period of time. You shouldn't just go from trading a 10 lot to a 1 lot overnight. It should go, like if your goal is to bring your value at risk down, you should go 10 lots, 9.9, 9.8, 9.5, 9.3, 9.2, etc. And kind of set like a 2 or 3 month task where for that period of time, it's kind of like dieting, right? For that period of time, you're in a bit of a position size deficit, so you're trying to gradually bring it down over time instead of quitting cold turkey and throwing your position size out the window. And then to finish up, before I ask you guys if you have any questions, we are running a discount at the moment, which is eligible on monthly and yearly and 3-year plans, which is 10% off if you use the code DWX10. If you use this code on a 3-year plan, not only do you get 10% off, but you also get a €200 coupon to go towards a permanent allocation. So I think it's €200. It might be slightly higher. It's to cover the cost of a 15% permanent allocation, but you don't have to use it for that. You can use it for one of the other permanent allocations instead if you wanted to do. We also ask you guys to please spread the word about Darwinex Zero. We're trying to make a difference in the industry. We're trying to give traders the best possible start that we can from a professional perspective. So we're really putting a big emphasis into the Discord right now. We've almost hit 10,000 members, and the guys in there are absolutely fantastic. There's a lot of people in there who are like-minded. They see the long-term vision. They know that Darwinex is their friend, not an enemy. So it's just a great place to hang out, come and meet some people, and generally just share trading ideas. We have a partner program as well for traders who have an audience or who want to look for a company to partner with and work long term. We're always looking for new partners. We want to build symbiotic relationships with people so that we can help you grow, you can help us grow, and we make the space a better place to be. And every trader on our platform has a member get member code as well, which effectively means you can earn 3 months subscription to Darwinex Zero by bringing your friends and family to the product. You have a member get member code. Just share that. As soon as your referrals have completed calibration phase and paid for 2 months subscription, you'll then earn a 3 months subscription with Darwinex Zero. Invite 12 friends. You're going to get a year's free worth of Darwinex Zero. And then finally, I just want to say a thank you to all of you joining. I think there's going to be less people watching today's session because we're coming into the close of the market for Easter. So everybody's probably getting ready to indulge in a load of chocolate, and the last thing that they're worrying about right now is their value at risk. But I promise you, these sessions will help. We run multiple sessions per week. We do an overview one, which is kind of ran as a welcome webinar on a Tuesday. On a Wednesday is my favorite session. We run strategy development sessions. So we look at traders' metrics. We do it live, and I provide statistical feedback or feedback on statistical variables that a trader can go away and take a look at and see if there's any improvements to be made using those statistics. And then on Thursdays, we run this Darwin explanation session, and then we usually have an AMA afterwards. But I can't do the AMA today, so we're putting that on pause for the week ahead. However, if there is any other sessions that you guys would like to see, and on Mondays, we're adding performance coaching with Sanjeev. There's going to be a small break due to bank holidays, and then Sanjeev's going away for a week. So I think there's going to be a couple of weeks break in between now and, I want to say, mid-May potentially. But after that, those sessions will be bi-weekly. So Sanjeev will be joining us every Monday in the Discord. I'll also be streaming it to X and YouTube too, to go over performance coaching, psychology, routine, habits, and how all of these things affect trading. And we're really trying to build our presence and give you guys as much as we can from a content perspective. But if there's anything you guys would like to see, please let me know, and I'll see if we can build it into the plan. There's no questions, so I'm going to call it a session there. So I hope you all have a fantastic Easter, have a great bank holiday, and I will catch you next week. Peace out, guys. Have a good one.